When you're in the early stages of building a startup, there's one question that never seems to go away, no matter how much you want it to. How are we going to fund this? Whether you're still prototyping in your living room or you're already starting to gain traction, securing the right type of financing can make or break your momentum. Raising capital isn't just about getting money in the bank. It's about aligning your funding strategy with your vision, values, and long-term goals. Normally, startups have two broad financing options: equity and debt. These are more than just financial tools. They're frameworks that influence everything from ownership and control to the way your business grows and evolves. Equity financing means bringing investors in who exchange capital for a stake in your company. It's often the go-to for high-growth startups aiming to scale quickly, especially when early revenue is low or non-existent. On the other hand, debt financing involves borrowing money and paying it back over time with interest. It's usually preferred by businesses that have more predictable cash flow or tangible assets. Of course, each route comes with its own set of trade-offs. Some are obvious, others less so. Equity can mean giving up control but gaining valuable allies. Debt can preserve ownership but add pressure to meet repayments. For founders, understanding these dynamics is crucial. Making the wrong decision can lead to unnecessary dilution, crippling interest payments, or even losing the business altogether. At the most basic level, the distinction lies in what you're giving up. With equity financing, you're selling a share of your company to investors. In return for their cash, they receive partial ownership and the right to benefit if the company succeeds. Depending on the arrangement, they may also have influence over key decisions. That is, appointing directors, approving major expenditure, or guiding long-term strategy. Debt financing doesn't involve giving up any ownership. Instead, you borrow funds under the agreement that you'll repay them with interest, usually in regular installments. As long as you meet those repayment terms, the lender has no claim on your company or its future profits. It's a straightforward transaction. You get the capital, they get their money back, plus interest. In short, equity means sharing the business, and debt means promising to repay. Every startup involves risk, but the way that risk is distributed differs significantly depending on how you raise funds. When you raise equity, your investors take on a lot, if not most, of the financial risk. If your startup doesn't perform as expected, they could lose their entire investment, and you're generally not personally liable to repay them. That makes equity a lower risk option for founders in terms of financial exposure, but it comes at the cost of giving up future value and decision-making power. With debt, the risk largely sits on your shoulders. You're contractually obligated to repay the loan, regardless of how the business performs. If things don't go to plan, for instance, delayed product launches, sluggish sales, or unexpected expenses that crop up, as they do, those loan repayments can quickly become a burden. In extreme cases, defaulting on a loan could lead to legal action or the loss of business assets. For early-stage startups with reliable revenue, this level of obligation can be risky. But for those with stable income or short-term financing needs, debt can be a manageable and even strategic tool. It's easy to look at interest rates on loans and assume that debt is the more expensive option, but that's not always the case. Debt financing has fixed costs. You agree to repay a set amount over a specific period of time, usually with predictable interest payments. Once the loan is repaid, your obligations end and you retain 100% of your company. Equity financing may appear free of immediate financial burden. There are no interest payments after all, but it can cost far more in the long run. Giving away a slice of your business means sharing your profits indefinitely. If your startup becomes highly valuable, that small percentage you gave away early on could turn into millions, if not more. In this way, equity often becomes the more expensive choice as your company grows, especially if you've undervalued it in the early stages or raised too much too soon. The problem is, it's tough to know how well your company will do in the long term. Another key difference lies in the level of involvement your financiers have in your business. Equity investors often bring in more than just money. They offer mentorship, networks, strategic insight, and sometimes a powerful reputation that helps attract further funding or talent. That's a major benefit, particularly if you're entering a competitive or unfamiliar market. But this support comes with strings attached. Investors may want to say in how the business is run, including decisions around hiring, spending, or pivoting. Depending on the terms, you might even lose the ability to make major moves without their approval. Debt providers, by contrast, tend to stay out of your business affairs, as long as you meet your repayment obligations, of course. This hands-off approach is ideal for founders who value full control and have a clear vision that they want to pursue independently. There's no one-size-fits-all solution. The right choice depends on your business model, growth plans, risk appetite, and long-term goals. Take the time to weigh up your options, seek advice from experienced founders or mentors, and align your financing strategy with the kind of company that you want to build. With a clear understanding of both parts, you'll be better equipped to choose a route that not only fuels your startup today, but supports its success well into the future.